Yes, so in the first half of 2015, we delivered an operating profit of $576 million, which was 25% down on the same period last year. Clearly disappointing to report a lower profitability, but still actually a solid performance. First half production was down about 3% on the same period last year at 15.6 million carats, compared with 16 million carats in the first half of last year. Lower production from the larger Rapa mine in Botswana, but also given the softer market conditions that we saw, we trimmed back production a little bit from some of our tailings treatment plants as well. One of the most pleasing elements of the results in the first half of the year was our response in terms of tightening on our cost base. Unit costs of production were about 10% lower than in the first half of last year. Exchange rate movements helped that. We have our predominant cost base in Southern Africa and in Canada, and currency movements against the dollar meant that those costs translate into lower dollar equivalents. But even so, we had productivity improvements that also helped to offset inflationary cost pressures and deliver a reduced unit cost production performance. Our rough diamond sales in the first half of the year were down just over 20% at $2.7 billion. That was mainly due to a reduction in volume sold at 13.3 million carats in the first half of the year, or 14 million if you include 100% of the share of sales through joint ventures. Average prices were actually slightly higher than last year. Last year we had an average realized price of $192 a carat. It was 206 in the first half of this year. That's actually more due to mix than the underlying pricing. Underlying pricing was actually 4% down, but we sold a slightly richer product mix in the first half of this year, and that's what gave rise to that higher average price. The biggest part of Element 6's business is serving the oil and gas drilling sector. And with the lower oil price, there was a significant reduction in activity in oil and gas drilling. So Element 6 saw a significant, about 20% reduction in their revenue year on year. But Element 6 have responded in a very positive way. Firstly, in other sectors of their business, they're really reaping the dividends of their continued work on innovation, and saw sales increase in the automotive sector, in the aerospace sector, and in consumer electronics. So really good performance in other sectors of their business. And they've also been quick to respond in terms of cost, optimizing their manufacturing capacity and making sure they contain costs wherever possible. So a really creditable result in the face of a very difficult market. We continue to invest in our major mining projects. In addition to Gaucho Kué, we have the Venetia Underground project in South Africa, the work on Cut 8 at the Jwaneng mine in Botswana, and now building a new evaluation vessel for our Debmarine Namibia business. For the first half of this year, we reported a return on capital employed of 12%. Given the lower profitability, that's actually slightly lower than we reported at the end of last year. It's worth noting that we've changed the way that we calculate our return on capital employed, so the comparative figure for the end of last year is now 13%. We previously reported 15%. Given the softer trading conditions, it's even more important that we keep our focus on our cost base and on making sure we spend our capital expenditure wisely to make sure we optimize that return on capital employed.